So a board can be very friendly for a period of time, that get not friendly for a period of time, sometimes become friendly again. So those are truly living organisms that evolve. And therefore, you need to know exactly where you are and what the situation is. And it's not just the situation of the company, it's the very specific chemistry between the board members and management at any point in time. And based on that, you can allow yourself to relax or not relax, use humor, not use humor.
Welcome to the Startup CEO Show. I'm your host, Mark MacLeod. In this episode, I sit down with Matt Turck, general partner from FirstMark Capital. This is my first conversation with a venture capitalist, and I went after Matt because I think he's the funniest guy on Twitter or X, or whatever you want to call it, and also the most insightful. I knew I would learn a lot from this discussion, and he did not disappoint. Matt has been an AI investor for a long time, and so we went pretty deep into that and just the market in general. And I don't want to take away the punchline. You're just going to have to listen or watch, but this was a great episode. I hope you love it. Matt, welcome to the Startup CEO Show. It's a true pleasure to have you here. How are you doing today?
I'm doing wonderful. Thanks for having me.
It's my pleasure. This is actually a milestone episode. I know you've been a CEO in the past, but this is the first non-CEO guest that we have and the first VC guest that we have.
The podcast is officially going to the dark side of the force.
It's going to the dark side, literally. And, I wanted to have you on the show for some time, because you are probably like the only reason why I go on X.com. And now that I follow you on LinkedIn, I probably have literally no reason to go on X.com. So my first and most serious question is I realize you live in New York and there's lots of underemployed comedians and writers in that city. Do you have a team? There's so much humor in your content. How on earth do you pull that off?
I appreciate it. I will pass on your good words to my extensive team of ghostwriters.
Yeah.
So I don't have ghostwriters. I do all of this myself. The self-aggrandizing version of this is that I always had a little bit of a creative side. I always a little bit of a writer I was as a kid, and so there's a little bit of sort of pent up desire on my end to do something content related, which is why I write stuff on socials, which is why I run a big community in New York called Data Driven NYC for the last 12 years, which is why I started a spin-off version of that community into a podcast last year. I just really enjoy creating content, and it comes very naturally, and most importantly, I find it enjoyable. So now. I'm glad. Thank you for the kind words. I would argue that one, I make more or less the same jokes, a variation thereof. One, and two, the bar is incredibly low, right? I mean, being funny on LinkedIn is not exactly a claim to fame. But look, if there's any learning from this for anyone listening, anybody that thinks in terms of content strategy, which again, in my case, I don't do it as a strategy. I do it because it's fun. I enjoy doing it, and it turns out people like it. So it turns out that it does have actually pretty tremendous sort of positive consequences in terms of networking, visibility, content marketing, all of the things. But that's not necessarily the goal in the first place. But to reverse engineer it, if there's one learning for folks, it's probably do what comes somewhat naturally. So if you're a startup and you want to create content that's going to resonate, if the CEO, because it often needs to come from the CEO, likes to write, you should do written content. If that's somebody that's much more comfortable speaking, it should be video, podcast, that kind of stuff, but just leaning on whatever comes naturally.
Maybe related to that, actually, before we go there, I'm curious, you're an early stage investor. The deal, startups are like whack-a-mole, and there's one issue that gets fixed and another pops up, and so shit gets serious sometimes, and there can be drama. We think everything's fine, and now we're being disrupted by the next version of OpenAI. I'm curious, how does humor show up for Matt as a board member? Like, do you use it to disarm the drama? Does it show up at all, or is it strictly your online persona?
I use it more often now, but there was a period of time as I basically learned to be a board member where I wouldn't do that. Like, you joke a little bit at the beginning of a board meeting, but really not during. And I've allowed myself, who is more experienced, to do that. So to sort of reconcile those two parts of my personality. And there's tremendous benefit to do that. But the experience part is that it's actually very hard to be a board member because no two companies are alike, no two boards are alike, no two boards are alike across time. So a board can be very friendly for a period of time, that get not friendly for a period of time, sometimes become friendly again. So those are truly living organisms that evolve. And therefore, you need to know exactly where you are and what the situation is. And it's not just the situation of the company, it's the very specific chemistry between the board members and management at any point in time. And based on that, you can allow yourself to relax or not relax, use humor, not use humor. A lot of it has to do with knowing when you're in a bad situation or not. And sometimes things may look like they're a bad situation, but they're not. I think some smart VC, not me, said somewhere that being a good investor is sort of like, you're like that combat veteran. And when you hear the cannon somewhere, like all the rookies run around, and hide in the trenches, but the combat veteran knows exactly when something is dangerous, a situation is dangerous or not. So being a board member, and I think one needs to be very careful with war analogies when talking about business, because we're talking about like emails and people sitting down in conference rooms. But directionally, that's a little bit to that. Is knowing what is important, what is not important, and then what is the specific context of the company, the market, and the chemistry across board members. And when you think about it, it's very much a complex system, and it takes years and years and years, as it turns out, to become somewhat good at it.
Yeah, I mean, you're in an apprentice-driven craft. You just sort of have to put the reps in, right? And then learn from your partners, and there's some osmosis, lots of trial and error. And like, I know lots of investors, and even though they're in a partnership, they actually describe their job as pretty lonely. Like they meet for their partner meeting and then they disperse virtually or actually to, the four corners of the country to meet with entrepreneurs. And so you actually have to rely on yourself for a lot of that learning. Is that your experience as well?
Yeah, 100%. No, it's very much an individual sport. So you do it in the context of hopefully a supportive platform that's accretive and helps and all the things, but it's very much an individual sport. Like I'm so lucky that I'm in a very generally supportive partnership and a great firm where people do care about one another and all the things, and we're small enough that we are not in those bigger firm situations where you have to play politics and have to go before a company presentation, pre-sell your deal to partners individually with the unspoken quid pro quo that if they support your deal, at some point in the future, you will support their deal. So fortunately, we don't have any of that, which again is a privilege of a human-sized partnership, and we all in one location in New York, so that helps a lot. As we've all learned, coming back from the pandemic, spending a lot of time in person really helps. But yeah, so if you're lucky, you're in a situation a little bit like this. But regardless, yes, you have to find your own deals, you have to close your own deals, and then you're on a board representing the partnership and the firm. But you're the one person.
Going back to content, I'm curious. One super fast question: like, has this content manifested in terms of new deal flow? I would imagine your top of funnel is quite large as a result of folks wanting to work with you. Is that true?
Yeah, so it's look, it's wonderful for top of the funnel, which is sort of what you would imagine, but it's also very good for the bottom of the funnel. So it's great for marketing. It's also great for sales, especially look, take AI today. So I love AI. I've been investing in AI for a very long time. It's a little bit of a weird market in that overnight, every VC became an AI specialist.
That's right.
So somehow you need to be able to convince founders and evidence to founders that actually you truly are somebody that spends a tremendous amount of time in the space and has done the reps and all the things. And, what is better than, hey, I got this community data-driven NYC, 20,000 people, largest meetup in the country. I've been doing this for 12 years. We've had, 400 speakers, 120 events on the one hand, or the podcast, which is, just listen to the conversations. Like you'll see me every week talking to people at the very forefront of the space, and then you can judge. Like you can decide whether you think the conversations are interesting or not. But it's evident. So those are almost like. It's going to sound corny or whatever, but like sort of sales-enabled materials, right? Or when you're on one-on-one conversation at the bottom of the funnel, and you try to make your case that you're somebody who truly cares about the space, truly understands what the entrepreneur is trying to build, and therefore you're going to be a great long-term partner for them. It helps to have all of this to make your case.
Yeah. I mean, it strikes me, right? FirstMark's a tier one firm. You want to back the really special founders, and they're going to have the luxury of choice, and this might just help pre-sell them and have them want to work with you.
They certainly will have the choice. Yes, it's this industry seems to be getting more competitive every day.
Last question on content. I see lots of CEOs like yourself who are also creators building personal brands, and I'm wondering, what do you think of that? Is that something you recommend to your CEOs?
Yes, especially in the early days, and I don't know to which extent that's a little bit of a contrarian kind of advice, but we now live in a world of noise. We are bombarded with content. Content marketing used to be a differentiated strategy a few years ago. Now it's become table stake. So content needs to be good, which, as per the above, probably means that it needs to be authentic. And content needs to be personal as well. And content coming from a person tends to work a lot better than content coming from a company or a brand, especially in the early days where nobody knows the brand. Therefore, I'm a big believer in the concept of CEO as chief marketer. The person that's going to create a lot of the content, have their own voice, and just like make it personal. I think people naturally resonate with something that's authentic, personal, makes sense, human story, and I think directionally the CEO is incredibly well equipped to do that. And there's a whole group of people that do that at all levels of scale. By the way, you can take I think Arvind at Perplexity AI is a great example of this. He's relentless on social media and he's very good at it. And for a company like his, which is a consumer company, which revolves around getting more users and more users and more users. Building a strong social persona is really important. He's done a masterful job at it in just a couple of years. When people say it's really hard to grow on Twitter, he went from zero-ish a couple of years ago to whatever he has now, like 250,000 or whatever last time I checked. So that's a great example. But even in much later stage companies, you see somebody like Ali at Databricks. He runs arguably the top enterprise company that like everybody raves about, that has like all this momentum and all the things. And, look, whether that's him or not, I suspect it's him, but he's on LinkedIn all the time. He's like publishing, content, interesting content about like, okay, we're very proud of this feature and that model, and we're supporting this project and all the things. And he really has a voice, and that's really, the Databricks voice. So that works at that scale. And, you could argue like all the way, like, think of whatever top company. Like people think of Microsoft, but they really think of Satya, right? People think of Salesforce, but they really think of Mark, and they have for the last 20 years. So I'm a big fan of that concept, especially in the early stages. But I guess my point as well is that even in later stages, the persona of the CEO is incredibly important in terms of like building that brand.
That makes a ton of sense. Yeah, I love it. Maybe let's chat about unicorns. So you've had some, these fabled things with the horn.
Especially in 2021, like all my companies were unicorns, which clearly demonstrated that I was a genius.
Absolutely,
right? We were all geniuses in 2021.
That's right. I mean, you only exist for markups. It's not for DPI. It's strictly for markups. Yes. So it's all good.
That's right. Those are the rules.
So I'm curious, if you look back, if you see any common patterns or aspects about the unicorn companies that you've been a part of.
Yeah, look, so there's, jokes aside, there's a conversation about like unicorns versus, real companies. So, indeed in 2020, there was this crazy inflation around valuation. And as a result, I'm sort of kidding, but not kidding, like pretty much all my companies, like every single one of my later stage companies became unicorns, which was kind of strange. As it turns out, that was and still today very much is somewhat disconnected from what the business truly is underneath. And ultimately, especially as you get closer to public markets, what really matters is the actual business. So I guess the question you're asking is, those companies that truly have a business and scale and have a like real revenue and like real sort of like financial performance. What do they look like? And look, at the risk of sounding trite, it's really right people in the right market at the right time.
Yeah, there's a huge element of luck and timing, no question.
And look, that sounds VC cliche kind of thing, but like the more you do the job, the more it becomes incredibly obvious, right? So, right founding team, and we can decide, we can discuss what that means. Right market absolutely matters for sure, and it can be a small market, and it can be a market expansion play, or it can be a very large market that's ripe for disruption. And then the right time matters immensely, and that is so tricky. Being too early to market is super hard. Being too late to market is super hard. So you want to be roughly in the window. And look, sometimes you're too early, but thankfully you're only early by a year and a half. So you have enough cash, to go through the desert while the market forms, and then you're like in the right market at the right time. But once the three things happen, which happen pretty rarely, that's the sad truth. When the three things happen, then you see companies getting to product market fit pretty quickly, which is this amazing sentiment, amazing feeling when you feel that the market is starting to want more of your product and more of your product, and you're in a pull situation rather than in a push situation. And then when that happens, then you see the best team executing with great velocity. They see, okay, this thing is starting to really crank. So all systems go. Speed is extraordinarily important at that moment. And then things compound, right? So you want to let the compounding happen, and you build, especially if you're in sort of the B2B enterprise side of the world. That's still to this day the beauty of the SaaS model, where like things just like build and build and build and build. You could argue, it's probably true on the consumer side as well, where your brand keeps getting bigger. Maybe you're so lucky to have like real network effects, and that keeps getting bigger as well. But it's that compounding that leads to escape velocity, and when that happens, that's very special. So yes, that's what those success stories, those companies, whether you call them unicorns or, high revenue companies, that's kind of what they look like.
Mm-hmm. I love it. No, that's super helpful. I was the CFO at Shopify when FirstMark did the Series A.
Actually, did not know that. Amazing.
I've studied Toby and that company a lot. It's the single largest portion of my net worth, so I have a vested interest in following it.
I'm sure it worked out.
Yeah,
amazing. That's fantastic.
But and now I coach CEOs, so I'm always looking to kind of reverse engineer success. And there's a few things that Shopify illustrates for me, right? One, like a founder who's completely obsessed with the problem. Like, it's not about like, oh, there's a big market, there's money to be made. It's not about, hey, my product's amazing, because that's a closed mindset. Like, he's just obsessed with making commerce simpler for everyone so that anyone can launch a product-based business, and he's not done, right? He doesn't need to work. He works as hard as he ever has. So complete obsession with the problem. When I have like a pie chart of all the elements of value creation over the life cycle of a company, I would argue the biggest single slice is go to market, to your point around repeatability, right? Once you figure out that recipe, just keep making that recipe over and over again. Never compromising on leaders. If I think about the number one topic that comes up for me in my coaching, it's leaders who used to be great and who are no longer great, and what do I do with them? Yeah, luck and timing, nothing you can do about. But I don't know. Those are like very small pattern recognition that stands out for me.
Yes. And then I guess it's there's so many aspects to that conversation, but to the leader stuff, companies that can be talent magnets early on, that seems to be a very strong leading indicator of success. And you can sort of tell, in the first year, like the quality of the engineers that join, the quality of, anyone, like even the first kind of like business / operational person. And, great people tend to attract other great people, and that virtual circle happening.
And Shopify definitely checked the box there, right? Like Toby was so involved with
Ruby,
thank you, Ruby on Rails. He was super involved with Ruby on Rails. And so he had some amazing early developers. And Harley, I don't know if you ever met Harley, the first business hire he made, but guy's a force of nature, just like wrecking ball. So so I think he checked the boxes there. I'm curious, you talked about all those markups you had in 2021. Did you know at the time that you were doing stuff that made no sense?
It's a great question. I think in general, the sentiment on my end, but I would say across a number of my VC colleague friends, was that no, it didn't make sense in the grand scheme of things, and at some point the music would stop. However, especially for my growth friends, growth stage investors, I think the general feeling was, you got to play the game on the field. And you can't just completely opt out of investing in like 2 or 3 cohorts just because you think you can time the market better than anybody else. So now, of course, there's a spectrum. There are people that went truly all in and invested entire funds in 2021. And, that's a complicated situation. The more established funds that did that have the benefit of a prior track record that they can lean on and just say, hey, basically, please give me a little bit of a mulligan for that.
That was a drunken orgy,
fund.
Sorry.
Yes, exactly.
I'll do it again.
Everybody else was doing it. But like the people that had the misfortune of just getting started in this job in 2019 or 20, as a new partner or like a new fund, and they were hyper active during that period of time. That's why we see so many musical chairs and movement in the industry right now. And Look, I mean, it's not a good thing. It's not a fun thing. Some people think it's a healthy thing, but I think a lot of people that find themselves in this situation just did what they could do at the time. It's not like they were idiots, or it's sort of like that the misfortune of showing up at the wrong time. Look. Some people pushed it a bit, for sure, but many others didn't.
It's easy for me to be an armchair critic, that's for sure. And like for me, like at the time, I was just like, there's history, right? We have sort of decades now of technology companies and valuation precedents, and it's like, man, these SaaS companies normally trade 5 to 8 times revenue, and now they're getting 60 times revenue. I don't know how, like, I'm not good with math, but I don't see how this is going to work out.
This last year or two, but like even before that, we've been effectively recreating the same situation in AI. A lot of people, I imagine, have had this little bit of like this split reality experience in my day-to-day, especially in 2022 and 23, where I would literally spend half of my day undoing the excesses of the past, managing, tough situation, risks, trying to extend runway for all those companies that I'd raised in 2019, 20, 21, and suddenly were finding themselves in a world that was very different, with very compressed multiples, general slowdown, B2B recession. So that was like half of the day. And then the other half of the day, because I'm an AI investor, data and AI investor first and foremost, I would find myself in conversations where we're effectively just recreating the same situation with a new cohort of companies. And look, it's this like kind of like whatever you call it, like externality kind of economic situation where you make what feels like a rational investment decision at a micro level. So you see a great company, it turns out to be a very competitive deal. You want to win the deal. You'd rather own less because you're paying a high price than not own anything at all. Therefore, you decide to go like all in, all out, and you just push, and you pay a higher valuation than you normally would. There's a framework where that makes a lot of sense at a individual level. The problem is everybody does the same thing. So the collection of seemingly rational decisions, when combined, ends up creating an abnormal situation. And the structure of the industry is such, there's so much competition, so many funds, and ultimately, a finite number of great companies that unless or until the fundamental structure of the industry changes, you're going to find yourself in those situations, again and again.
And so that's happening in AI. And to your point, you've been an AI specialist for some time. So let's talk about AI. Like I'm sure it's easy to imagine what excites you, but maybe what scares you as an investor?
I'm going to make the most unoriginal comment on AI, which is that I'm very bullish on AI. I do think we are now at a moment that has been years, possibly decades in the making, which is very exciting. For me, like the whole, whether you call it big data or, data infrastructure thing that played out over the last, 15 years, on the one hand, and then the whole evolution of deep learning, in particular since 2012, we had that moment where like those two things are colliding in a really interesting way. And for me, that was always part of the same fundamental mega trend. And it's happening, in some way, like for people like me, and it's not just me, there's others, but, ultimately not that many others that have been kind of like rooting for this to happen. The fact that it's happening now is very exciting. Those things always take longer than one thinks, typical Amara's law thing. People overestimate what happens in the short term, underestimate what happens in the long term. So we're clearly in that moment as well. But, with all the money that's going in the industry and continues to go in the industry, that raises the stakes in terms of we're building the supply and building and building and building on the basis that if we build it, they will come. And the concern is, on my end, is how quickly they will come. So I have no doubt that they will come, meaning that the demand side of this market will materialize at a massive level, but it's going to take time. And you can already see on some like earning calls and like how the markets react. The markets which are, as we know, very quarter based. They tend to react very, in extremes to whatever little, smallest news. Meanwhile, demand is going to materialize for me like over a decade, right? And we see it. I spend a lot of time in enterprise AI, and the reality in enterprise AI right now is that people, last year did a bunch of kind of a low-hanging fruits kind of thing. So that's your chatbot, that's your enterprise search, that's your coding AI solution. So people have done all of that, whether that's pilots or deployments. They've done all of this. The other thing that they've done is bring in the consultants, explain to us, how we apply AI to our business. And all of this is great, and it's a great first stage or first step. But what makes enterprise AI really interesting is for everything else. So I would call that 10%. What's really interesting is the remaining 90%, which is, okay, how do we use AI to do things that are specific to our company, specific to our industry? How do we leverage our own data set to do things that our competitors cannot do or will not do as quickly? That's really the opportunity. And that is complicated, right? Because that means, first of all, where is our data? Is it, in a state? Is it clean enough? Is the quality high enough? Do we know how to sort of govern it, manage it, and all the data infrastructure kind of questions, which are now becoming super, super urgent if people want to do AI. So that's that. And then, do we have the talent? And as it turns out, generative AI is a whole new beast, and knowing how to just manage those models. That's a whole thing. And then, the change management, all those words like that gives me the shivers, like digital transformation, change management, like all the things, but which are fundamentally true, which mean that you need to convince humans and educate humans on what to do with all the things for which business case and how does that change their daily workflow. And some people will embrace it and some people will hate it and some people will, claim to do it and some people will actually do it but not talk about it. And, this whole like human kind of aspect, that's the real mess. And the whole situation that will evolve, but that takes many, many years. Once you really start talking to global 2,000 companies, federal government, all the things, which is where the many, many billions of revenues are, that's sort of where they are right now. So that's a long-winded answer to your question. But if the question is what I'm worried about that time and mismatch between an overbuild of supply and an overbuild of expectations on the one hand, and a demand that will materialize, but maybe not quickly enough for the whole industry to stick the landing.
Are you still taking your own meeting notes? Let me tell you about an AI tool that I'm using to take meeting notes for me. It's called Fellow. It's an AI meeting assistant. It takes human-level AI notes, it tracks my action items and decisions, and keeps everything in one place. Built with security and privacy at its core, Fellow is the only AI meeting assistant that leaders trust to capture meeting notes and recordings while keeping your data safe. Thousands of organizations are consolidating tools and relying on Fellow to capture their meetings. The team at Fellow is so confident that you'll love it, they're offering an insane deal to startup CEO listeners. 90 days of unlimited AI-powered note-taking and recording completely free. Visit fellow.app/CEO to sign up today and experience the AI meeting assistant trusted by leaders everywhere. Would you say the trust, demand being behind, do you think that's a trust issue, like AI is scary, I don't trust it yet, or is it a readiness issue? I know several Canadian big banks still run systems on Cobalt. So thinking of how to work with the latest AI is just too big a stretch,
All the above. It's a systems issue, architecture issue, where is our data issue, and then human preparedness, human appetite. AI is like this weird thing fundamentally, in that it's, as we know, it's stochastic, not deterministic, meaning that it's not going to provide a correct result 100% of the time. It's actually not going to produce the same result 100% of the time. So it's a whole new way of thinking about it. I think there's this perception in the enterprise that if you wait long enough, then AI is going to evolve in a way that is going to be 100% correct 100% of the time. In fact, that's never going to happen. It's going to get closer and closer through a combination of improvements of the underlying models and then a lot of RAG, but you're not going to get there. So it's like a mind shift as well, which probably means that you can't use AI for all the use cases. For something that's in front of the customer and that needs to be right 100% of the time, that's probably not a good idea. But then what is it a good idea for? And you need to think about it again in the context of your business, in your industry, with your data and all the things. So it just takes time. It's a big effort. It's in like an evolution. Everybody needs to learn, understand how those things work, what they're good at, not good at, and then you need to be able to control it and govern it. And not to be the VC that shields for their companies, but I'm a very proud investor in Dataiku, which is exactly that, which is like an enterprise AI platform that enables you to do all the things, integrate all the forms of AI and analytics and, metrics, models, agents, and govern it. And, the reason why I'm very bullish on the company is that that's what the market needs now. It's like control, governance, organization, and, doing the things in an orderly manner that doesn't create chaos.
That's really helpful. I appreciate that. So I've been mostly a SaaS guy. And I wonder if you think SaaS is just going to die and be replaced by AI. Like if SaaS is fundamentally a database and you have to work to get value out of it. And now we're moving to this world where software works for you. Like one of my CEOs feels like UIs will just auto-generate in a few years. What are your thoughts? There's a tremendous amount of market value tied up in SaaS. Do you think it's at risk?
I mean, some of it is at risk on an individual company basis, for sure. As a category, I don't think SaaS is dead. I think SaaS is going to evolve into SaaS 2.0, whatever you want to call it, which is going to just incorporate a lot of AI natively to do a bunch of different things. So if you think of SaaS fundamentally as a way to buy software, subscription model, to deliver software through the cloud, that there's a fundamental need to do the things. So I think you're just going to have a generation of companies that are going to be much more either AI native or where AI will become a huge part of the business, and that this transformation that's happening. So clearly you have an extinction risk for certain SaaS companies that don't move fast enough. Clearly, AI native companies right now have tremendous amount of momentum, and in some ways it's kind of unfair. But people look at them as AI native, what the future is, and then you have those older companies that just have the bad fortune of having started in 2007 or 2012, and therefore are not considered AI native. And in reality, some of them brought in a lot of AI and sort of do the same thing as the AI native companies, but from a brand and marketing perspective, they're perceived as being on the receiving end of AI versus being part of the disruption. So that's all of that is playing out, and I think the net result is you're going to have a whole generation of companies that are going to be those combination of AI and what we think of SaaS from a functionality perspective. So combination of databases and agents and all those things. I do think that at the margin, there's going to be certain companies and certain types of needs that are going to be addressed natively by AI. So if you think of coding capabilities, I think that's actually pretty disruptive. I would argue that it's probably mostly disruptive to custom software. So as we know, in the enterprise, broadly defined, there's tremendous amounts of like homegrown custom things to address needs where the market is too niche for a SaaS company or a SaaS category to have emerged. I think that's going to get replaced by AI because, indeed, it seems that the world is evolving very quickly towards being, enter a prompt, see application come up.
So you've been an investor for a long time through different technology movements. Is it more or less difficult to form lasting conviction about an investment thesis in this world versus previous ones?
It's the same, it's the more you do the job, the more you sort of go back to the basics. So it's a little bit like speaking of Twitter content and memes, it's a little bit like the noob curve. You know what I'm talking about, like the sort of a Gauss thing, where basically you start at a point, then like in the middle, year 3 or 4, your sentiment evolves, and then you sort of go back to where you came from on the other side of it. And, VC investing 100% fall in that category from my perspective, where you start year 1 or 2, and basically largely because you heard it from other people, you say, well, I'll invest in the best founders I possibly can find. And then you get to your 2, 3, 4, 5 of your career as a VC, and you're like, oh, well, what about, CAC 2 LTV or NRR or, all the things. And then, you're 5, 6, 7, 8, or maybe faster for like people, are smarter than me. You go back to, I'll invest in the best founders I possibly can find. And of course, like the nuance is that what you consider to be a great founder at the beginning of the journey versus on the other side of the journey evolves a little bit, and your kind of radar and intuition.
Also, your access, the founders you have access to is going to be very different.
Hopefully, if you did well. But so if you look at it from that perspective, sort of whatever happens in the world, ultimately you invest in hopefully great people for a very long-term journey towards a long-term goal. So you have to believe that those people will have the grit and resilience to continue whatever happens, evolving with the final goal of like disrupting whatever industry, or, disrupting is always a little bit of a double-edged term, but like, building the little part of the world that they are super passionate about. And that's, a 10-year journey regardless. So whatever happens, month 6 or months, 24 matters less. Obviously, as long as you stay alive and all the things, and there's different ways of getting to that goal. But that's how I view it. So I don't think today is either harder or better. Yes, the world is changing quickly, but we have been for the last 30 years, 40 years in a moment of just profound transformation of the world. So today is not any better or worse. I do think it's compounding and accelerating. Like, I don't want to minimize the fact that the world is changing very quick in ways that are unsettling, and this whole separate conversation about the actual impact of AI, when that demand materializes and all the things, which again I think will going to take time. But when it does happen, I do think that's very disruptive in all sorts of different ways, socially, emotionally, humanly, personally, and all the things. So the world is changing, but for purposes of what we do, the fundamentals remain.
I'm actually fascinated by that curve, right? I start backing the best founders and I come back to backing the best founders. You're a tier 1 fund competing with other tier 1s who all have access to the shiniest founders. And you're an early stage investor, which means those rounds happen relatively quickly. How do you form conviction kind of so rapidly?
So, going back to some of the cliches of venture capital, but again, there's a reason why they're cliches. So, prepared mind is something that people may have heard about, which is this idea that you do work up front, and that can be industry work, that can be general company category work. It can be, founder work where you've sort of kind of fine-tune your own model, if you think of your mind as an AI, based on like founder data. But like you show up in those conversations with an opinion. And when it so happens that the founders match that opinion, then you know pretty quickly. And then, yes, you have to act fast in a context of maximum ambiguity. The world where for the best companies show up in your office, have 2 or 3 million in ARR and are willing to answer all your questions and are not talking to any VCs and tell you have all the time in the world to make your decision. Yeah. That is long gone. And maybe it existed at some point, I don't know, in the 80s in Silicon Valley. Maybe even then it was not the case. But like in our world, that's just it's just not the case. But again, like you do this job long enough, you build. You sort of know very quickly in a conversation whether that's something that you're going to be excited about. And again, prepared mind, like you've done the work and like that whatever they're doing is interesting. Because you've done the reps and that like this specific thing, that's where the world is going, because it so happens you spoke to a bunch of Fortune 500 CIOs that explain that it's a problem that they have, whatever heuristic, but like you've done that, and then you meet people that have that clarity of thought, where they explain in very precise terms why what they're doing is important, why it's almost inevitable that whatever little part of the world is going to evolve the way they describe it, and why they're the right people to do it. And when that happens, and it doesn't happen that often, it's very special. As an experienced VC, you sort of know pretty quickly.
That really resonates. The reason why I left Shopify actually was to join a venture capital fund. I went to the dark side for a bit.
Yeah, that I'm aware of.
And one of my observations was that the best investments were based on a crisp, simple insight. It was crisp and easy to articulate. It was just unfortunately not obvious at the time of investment, hence the venture aspect. But like the entrepreneur's ability to just synthesize everything, have unique knowledge, have alpha, to use an investment term, but then just convey, they have such mastery over the topic that they can just tell you crisply. Like you can walk into a partner meeting and you just recite it verbatim. And so complexity, if the entrepreneur struggles to convey what they know, that for me was like a negative investment signal.
No, that's exactly that. Like another mental model for it that I think about pretty often is value capture versus value creation as an investor. And what I find, at least for me, is that whenever I think there is a value creation opportunity, meaning I see some kernels of interesting things here, and it seems to be a good enough founder in a good enough market, and it seems, but it's going to take a lot of work even to help them sort of refine their vision and all the things. I actually do enjoy that work, but from experience, I'm not a great investor in those scenarios. However, sometimes when you have that, crisp insight that you were describing, and that sort of, those founders with like deep clarity of thought, it feels like a value capture kind of moment, which I don't know, may sound terribly cynical as an investor, but it feels like that train is leaving the station. Like, do you want to hop on it or not, right? And it's that feeling that is very special, and whenever I have it, it's one of those hell yeah moments when you just like really want to do the deal. And So that's, value creation versus value capture.
Maybe as we approach the finish line here, I'm going to hit you with just a few more, maybe more practical questions for the audience. So one for any AI CEOs who are listening or watching. There was like an exodus away from San Francisco during COVID, and now I feel like people are coming back, and especially it's becoming a hotbed for technical talent in AI. And so I'm wondering, do you feel as an investor, do you evaluate AI companies differently depending on whether they're in SF or not?
Yeah, so one of my favorite topics, the East Coast versus West Coast wars.
Yeah, it's like a hip hop battle.
Yeah, exactly.
Smalls.
Yeah, exactly. I made a fairly obvious joke at some point. Like I must have a tweet if I didn't delete it, where I said 1990s was like East Coast versus West Coast rappers. And 2000.
Oh yeah, rappers. I saw that. Yeah.
Yes, East Coast versus West Coast rappers.
That was awesome.
So to get the obvious out of the way, San Francisco is the biggest tech ecosystem in the world. It's an extraordinarily special place. The vast majority of enormous and incredibly successful companies in tech that were built in San Francisco and Silicon Valley. All of this is obvious, undisputed, and I'm not going to dispute it. It's true in AI. There's tremendous energy. OpenAI and a million other companies, all the things, undisputed. At the same time, I would argue that if you stop here, you actually miss one of the biggest successes of Silicon Valley. And the biggest success of Silicon Valley is actually not Facebook, it's not Uber, it's not OpenAI. It's the fact that Silicon Valley has very successfully exported its model and its way of thinking to the rest of the country and the rest of the world. And that has been an extraordinary means of creating massive economic value around the world in a way that even in Silicon Valley, I don't think people fully realize if they don't spend a lot of time in other ecosystems. So look, that's certainly true in New York. That's true, in Israel. That's true in Europe. That's, true, albeit in a very different way in China. A very different way in India, in a very different way in Brazil, but it's like all over the world, and variations, local flavors, and you could argue that these ecosystems are not as good, they're nascent, and there's a whole evolution of these ecosystems where effectively you need to have several, rinse and repeat cycles where you have companies that become very successful, then create wealth and expertise and redistribute to the system and all of the things, and that rinse and repeat cycle has been happening in Silicon Valley for generations. You would argue that in New York, it's happened a few times. There's, maybe 4 or 5 generations of this happening. As you move east, to London, Paris, Berlin, it's maybe happened twice. Stockholm happened twice. And so all these ecosystems are forming really and accelerating. But, so that's, I think, something just really important that people don't talk about enough. For AI, it's very true as well, and you see it everywhere. So look, the first big IPO in generative AI is going to be CoreWeave. It so happens that CoreWeave is headquartered in beautiful New Jersey. The founders live in New York, in Montana, in different places, but they're not Silicon Valley insiders. And then, just look at Europe, there's just tremendously interesting companies, whether that's Mistral, Synthesia, in which I'm a very proud investor, 11 Labs, which, somewhere between Poland and London and Brooklyn. Black Forest Labs, there's this long list of great AI companies. There's some in Israel, there's some everywhere. So yes, San Francisco, fantastic, but if you miss the rest of the world, you're missing a huge part of the story. And as an investor, it so happens that it's what I focus on. I do a lot of sort of East Coast, Europe, Europe to New York, Europe to US. I would love to do more Israel to New York, Israel to the US as well. So, to the Peter teal question, like what do you believe, whatever that is, whatever you believe about the world, that most people would disagree with, especially today when we're like in a situation where like everybody's sort of very bearish on Europe, on Twitter or like in conversations in tech circles. I'm actually very bullish on a type of European entrepreneurial energy, which doesn't mean that Europe doesn't have its own problems. But I think, the companies that grow in Europe are very resilient, have a lot to deal with. And you see a lot of people, like an entire generation of founders that want to build global companies from day one. They don't want to be the best companies in France or Switzerland or wherever. They want to be the global category leader. They happen to start in Europe. But that whole model, especially for B2B enterprise companies and B2B AI companies, of build it in Europe or Israel and sell it in the US, I'm a huge fan of. And, to my surprise, it's somewhat contrarian these days.
Yeah, I can see that. But yeah, that's clearly some great examples. I mean, a really old school example would be Zendesk.
Yeah, no, if you look at the in New York, for what it's worth, like some of the very best companies of the prior generation or current generation, like so the companies that clearly have become successes, and whether you think they're modern companies today or not, you can argue, but like UiPath, headquartered in New York, like that whole generation of like the Calibras. You mentioned the Content Square, which is still a young company, and then all the Israeli companies like Wiz, is headquartered in New York. Sayera, which is a younger Israeli companies in cyber, but like doing incredibly well, is in New York. Dedaiku, that I mentioned, has been a New York company since I did the Series A in 2016. So if you remove the European and Israeli companies from the East Coast, and there's some in Boston as well, you miss like a big part of the success. And all of those have become American companies, but like those are very significant multi-billion companies. Some of them are public and other things. And then if you include the European founders of American companies, then you start missing like the Datadogs of the world. And so yeah, it seems obvious to me, but like somehow there was a moment. So there was like a minute and a half where around the time of Mistral, I would walk around in Paris and would bump into all sorts of US colleagues, and that lasted about 6 to 9 months, and now it seems like everybody's gone away.
That's really fascinating. Maybe final question, Matt. What advice are you giving your CEOs these days? And realizing that's a very broad question, maybe like, are you telling them to be bullish or bearish? Like, what's the sentiment?
Generally bullish. I'm very bullish on like in general tech and the opportunities and all the things. I think it's truly one of those great moments in tech where you have an opportunity to build great companies across the board. I think that whole AI moment is just a wonderful opportunity, and in many ways it's sort of just starting, because look, the first sort of 2-3 years of the generative AI boom, that started, call it November 30, 2022, the kind of last couple of years, that's been very much an infra kind of discussion. It's been, GPUs and data centers, and then foundation models, and then, orchestration systems, like all that good stuff, vector databases. It's really been, the core focus on building the supply, to the earlier point about the supply. And we're sort of at a moment now when that stuff is, while evolving fast, is kind of in place. You sort of know how to do the things. You sort of know how to do RAG. You sort of know how to route queries across multiple models. People have learned very, very quickly. So now is a wonderful time to like turn all of that into the next generation of SaaS companies. Consumer products as well, but the SaaS 2.0 companies. Like now is the moment to think about, okay, what use cases are particularly ripe for AI disruption. So it's a great time to to build companies. And last year there was like this whole debate around thin wrappers, and there was this perception that if you were kind of a regular software company and all you did was really to add a layer on top of a Claude or GPT, you were not building value and you were just a reseller effectively, and you were just going to die a very quick death. And I think rightly so, the industry has completely changed its mind on that topic. And now the thin wrappers of yesterday have become the thick wrappers of today, because people have realized.
There's a joke there.
Yes,
I'm going to let it go. There's definitely a joke there.
But people have realized that just even at the infrastructure level, this stuff is reasonably complicated and involved. So as much as I was saying, well, now people have understood like how to use multiple models and wrap them. If you're going to be a solution like, speaking of Canada, like Ada in my portfolio, which is a AI customer service company that very much is a generative AI company now. If you're going to be delivering that kind of service to your customer based on generative AI, well, you sort of have to be on top of like every little thing that happens in generative AI, which, by the way, changes like 4 times a day, it feels. So you have to be constantly, reading papers and then testing models and evaluating models so that well, for this query, I'm going to route to, Sonnet 3.7, but for this other thing, I'm going to route to GPT 4.5, and for this other thing, I'm actually going to route to my homegrown traditional machine learning classifier. And that all of that is actually, that's not thin wrapper at all. That's actually pretty complicated to do this, day in and day out. And then on top of that, you got like all the SaaS stuff, right? Like, so actually authorization and authentication matters, are back, like all the things. And actually collaboration matters a lot, and so on and so forth. And there's a lot of work, and all of this needs to be customized for the specific industry or the specific problem that you're trying to solve. And, there's a lot of value there, and there's a lot of work to be done there. So I'm bullish on all of that, on all those companies, those thick wrapper companies, tech your industry, pick your problem, pick your geography, pick whatever, and then apply this kind of combination of like AI and SaaS to solve it. There's just tremendous opportunity now. So what I tell my CEOs is to be bullish, enthusiastic, stay very, very close to what happens in AI, and just go for it. It's a very special moment.
I love it. Well, I'm actually very encouraged to hear that. I thought there might be a bit more caution, so that's a nice optimistic note to end on. And I really appreciate you making the time, Matt. I was sure this conversation was going to be insightful, and it did not disappoint on any level. So I'm really grateful for you making the time.
Thank you. Really appreciate it.
Hey, thanks for listening to the Startup CEO Show. If you'd like to connect with me, be sure to visit my website at markmacleod.me, or follow me on LinkedIn at @themarkmacleod, or Twitter at @markmacleod_. And if you want to tune in again next week, be sure to subscribe on YouTube, Spotify, Apple, or wherever you get your podcasts. We'll see you next time.